Hello, everybody. It's Professor Hassey again. It's our week 6 weekend update video. And this weekend, we're going to concentrate on case number 3 and the electrics case, leading up to our week number 7 work, which is a work on mergers and acquisitions, and also a case number 4, which is a review of some of the information of the companies that you selected. But case number 4 will be posted on Sunday evening. And then I'll have an introduction to that case in my Monday lecture. But we're concentrating on case number 3, which the grades and the solution have now been posted to Blackboard, and also how case number 3 can help you with the electrics course assessment case, and leading up to a review session next Saturday, March 19th at 10 a.m. The Zoom link has been posted to Blackboard, and I'll post it again with this video. Again, it's a time on Saturday for a couple hours to review any questions you have. I will have a presentation about the format of the paper and what I'll be looking for in the paper lecture as part of that review session. And naturally, the review session will be recorded for those who cannot make it. But if you cannot make it and you have some questions, please feel free to forward those questions to me prior to Saturday, and I will answer them in our review session. But the case at hand now is case number 3, the beginning analysis of a capital budget analysis of an investment of $700,000 with a project life of 7 years. The bottom line of this case is that it is, yes, a good investment. The risk analysis, the base case return analysis all indicate good profits, good cash flow, good present value, good rate of return. That's the bottom line. But how did we get to that? Well, first of all, what is our weighted average cost of capital? This is 1/4 of the grade of this case. It's 25% is of the score of your grade on this case is made up in your calculation of average cost of capital. And a couple areas where some of us had some difficulties. In the case, it's told that our debt to assets relationship is 70%. It's told that our tax rate for this project is 20%, that the interest rate on debt is 6.5%. The risk-free interest rate is 1.65%. The market premium rate is 8.5, and the firm's beta is 1.3. Using that information, what is the risk to the company today as far as cost of capital? What is their opportunity cost? What is their hurdle rate? What is their discount rate to be used as your discount interest rate in your analysis of this case? Well, if I take the interest rate on the debt of 6.5% times 1 minus the corporate tax rate of 20%, that means 80% of 6.5 is my after-tax cost of debt. That's 5.2%. 5.2% times the weight of the capital structure in debt, 70%, gives us a weighted average cost of debt after taxes of 3.64%. The cost of equity, which is the relationship of the risk-free interest rate to the market premium times the beta of the company. In this case, I give you the market premium. Many of you, and I do mean many of you, took the market premium as the market rate of return and subtracted the risk-free rate to get 10.56%. Incorrect. I've done that calculation for you in this case by giving you the market premium rate. So it's the risk-free rate of 1.65 plus 8.5% times 1.3. So if I do that calculation, I get 12.7% as the cost of equity. 1.65 plus 8.5%, which is the market premium, times 1.3 beta, 12.7%. 30% is the weighted equity of this company with a debt of 70. Equity must be 30. 30% of 12.7 is 3.81. 7.45% is the total cost of capital. 3.81% is 30% of 12.7. I get 7.545%, our weighted average cost of capital, and that's our discount rate to be used in this problem. If you have an incorrect debt calculation, that's minus 5 points. If you have an incorrect equity position, that is minus 5 points as well. Now we take that and head to our capital budget analysis, where we're given a series of variables to do a base case analysis of this case. So based on that, we take $700,000 as the investment. For revenue, we take sales of 40,000 units times $45 per unit. That's $1.8 million in the first year, which is going to be inflated by 2% through the remaining years 2 through 7. We have a variable cost rate of $35 per unit times 40,000 units. We get 1.4 million. That is inflated at a 1.5% inflation rate through years 2 through 7. We have a fixed cost of $75,000, which is inflated at also 1.5% through years 2 through 7. Our depreciation is given to us as $100,000. That does not inflate. Our tax rate is 20%, 20% of the earnings before taxes. We get a net income of $180,000 in year 1, up to $251,411 in year 7. Once we determine our net accounting income, then we add in or subtract out our other cash flow items. First step, salvage value. It's given in the case as $55,000 in year 7. That means in year 7, we were receiving $55,000 as a disposal value of that asset, which we have to take tax out of, 20%. 55,000 times 1 minus T, which is 0.8, 80% of 55,000 is $44,000 after tax salvage value. Remember, we fully depreciated the asset over the 7-year life. That means it has a book value of $0. That means that $55,000 disposal is a gain on the disposal of that asset. So we have to pay tax. Many of us came up with the 44,000, but we forgot to include it in the total of year 7 cash flow of 557,578. Some of us missed that. We add back in depreciation of 100,000 since depreciation is a non-cash expense. Our working capital has a rate of 8%, 8% of the first year capital of revenue, 144,000. And then as the revenue adjusts to inflation, we adjust the delta by 8% and we get these numbers here. And then the entire amount is added back, 8% of year 7 revenue, 162, 167. So the net effect of working capital is 0 throughout the life of the project, but we're showing the capital needed to support the asset base in years 0 through 6, and then that being added back at the end of the project's life. And thus we get our total cash flow of approximately $2,392,235, which we discount back at the interest rate of 7.45%, and we get a discounted cash flow of that $2,000,004 to now $1,763,190. Take that as a comparison to the net cash flow in year 0 of 844,000. We get a net present value of 919,190. That's an internal rate of return of a little bit, almost 31.5%. A profitability index, the relationship of discounted cash flow to the net cash outlay, 2.09 times, and a payback in 2.93 years. All very, very good return figures. Thus, we would recommend the project because of these excellent return figures. It would be given a yes, as asked for in your case. Yes or no? I think a yes. So that's the base analysis. $919,190 in present day cash flow profit. internal rate of return of approximately 31.5%, a payback double the investment, and a profitability index of double the investment, and a payback in less than 3 years of the 7. Pretty impressive. Now we do a risk analysis of this. The risk analysis would be a determination of based on output and based on sensitivity variables. Let's take a look at that. So remember, the risk analysis is taking a look at scenario, which is a change in output of units on a yearly basis and the probability of that occurring. And the sensitivity analysis is taking a look at some indicated variables and how they change specifically as a percent of deviation and how that affects the net present value. And all you do is change those individual units one at a time. So the scenario analysis is taking our base case with a 55% probability of hitting 40,000 units and a worst case scenario of 25% likelihood of 32,000 units, and a best case scenario with a 20% likelihood with a 48,000 units, and the subsequent NPVs of those various profits at those various outputs. Weighted by the probability, we get a weighted net present value of 901,009. Still pretty high, even with the worst case scenario of only 32,000 units, we're still making over $500,000 in NPV. Pretty good. In the sensitivity analysis, it's taking the selling price per unit of $45, the variable cost per unit of $35, and the fixed cost, not the weighted average cost. This is where a lot of students miss. We had a change in the variables from our example that we used in class, and I was looking for the fixed amount. So selling price per unit, how it deviates from the original base case of $45 a unit. The variable cost, how it deviates from the base case of $35 a unit, and the fixed cost of $75,000, how that deviates from the base case. And we get these different projections of net present value. Notice at zero present value, zero changes, our present value is the same as the base case. And then I charted it out here on this chart, which the template drove the chart. Now I didn't take any points off if you didn't have the chart, but I did take points off if I did not see this range of change from top to bottom of the particular sensitivity NPVs of those variables. So that's the risk analysis of the capital budget case number 3 case. So there it is right there. The solutions are posted in Blackboard. All of you, or pretty much all of you, use the template I provided, and as you can see, it's a much easier format, a lot easier to read, especially for the reader like myself or anybody. And it gives us an analysis that we now can interpret as what the numbers tell us, and that's what we're going to be doing in the electrics case. So let's take a look at the electrics case, of which some of you I know are beginning to put together because you've been sending me your drafts of your work for review, and most of them are looking very good. There's just a couple of key areas that I've indicated before that we need to think about and adjust. Use the template provided in case number 3 and in the prior one. That's a great template to just insert the numbers. Now, you're going to have to insert some additional lines, and that'll equate to some of your Excel skills or your spreadsheet skills, but I can help you with that if you're running into problems. But I want to go over a couple of issues with the checklist and make sure we understand the numbers that we're working with, and as we begin to put together our capital budget analysis. Next week in our review session on Saturday morning, I will go over the paper format and explain to you what I'll be looking for in answering those questions given in the case analysis as you interpret the analysis that you're doing in this paper. At the same time, next week, you're also working on case number 3. So next week is a busy week, case number 4, excuse me. Next week is a busy week, but after you complete case 4, you have your final work is just to complete this electrics case. So the capital structure is pretty straightforward in this. The only difference, and we've talked about this, is in the information given to you in your exhibits. and most specifically, Exhibit 4, financing, is you're told that the capital structure in this problem is debt is 50% of equity. Debt is not 50% of assets. Remember, the capital structure is based on assets equals liabilities plus equity. Well, we've all worked on that, especially in case number 3. Liabilities are 70% of assets. That means the equity's got to be 30%. 70% plus 30 equals 100% assets. Well, now in this case, a little bit different wrinkle. We're told of the relationship not of liabilities to assets, but liabilities to equity. Liabilities is 50% of equity. Knowing that, how do I calculate the capital structure of the company? It's basically arithmetic. Debt is 50% of equity. How does that equate to the overall capital structure of liabilities plus equity equaling 100% assets? That's a task that you have to determine in this case to go ahead and determine your cost of capital. The project life of this company. The project life is 8 years. That's your depreciable base. That's the 8 years you're doing. The annual depreciation you have to calculate. You have to create a table using the MACRS depreciation table. And that MACRS is another way of calculating what it is. It's just taking a percentage per year times the asset value of the investment. And we are given in Exhibit 3 that the asset value is $17 million. So you have to come up with the percentage per year by finding the MACRS depreciation table, taking that percentage for year 1, year 2, year 3, multiplying by 17 million. And when you do that correctly, those total depreciations will total $17 million. So that's another thing that you have to work on, and that will be your depreciation number used in your case analysis. MACRS depreciation table for that. Salvage value. Is there a salvage value in this case? And the answer is no. 0 salvage value. So we do not have to worry about salvage value or disposal value in year 8 of this project. No salvage. All right. You are to do originally the average base case analysis. The average base case analysis is, that's your very first calculation, just like in case number 3, is the average case scenario with a revenue per unit of $9,200 per unit revenue, or let's just call that sales, and 40,500 units of output. That's the average base analysis to be used right off the bat in this problem. That base analysis is going to be your basis to do the sensitivity analysis in this problem, just like you did in case number 3. That's your base case to do the sensitivity analysis. All right. Now you're also going to have to do other analysis too in the scenario analysis, and those are down here, where you're also going to have to do a weak analysis and a strong analysis. But that's just like you did in case number 3. All you have to do is change the output number, and that number will automatically come up for you and determine the NPV of that scenario. And you can put that into the scenario table, just like you did in case number 3. Remember, the scenario analysis for weak is equal to $9,100 per unit sales. That's something a little bit different. We have a different sales figure or sales amount, revenue amount for each scenario. And it's based on 40,000 units. That's the weak analysis. The strong analysis, given in Exhibit 1, is equal to a revenue of $9,250 per unit in sales or revenue, and an output of 40,750 units. Those are your two scenario analysis in addition to the average analysis that you need to put into that table for a scenario. The sensitivity analysis is based on the average base case, just like you did in case number 3. And what you have to do there is, what is the sensitivity variables given to you in the problem? Well, the sensitivity variables are given to you in question number 6 in the analysis in the case on page number 4. There are 2 sensitivity variables: the selling price, the sales price. Oops, where did I put that? Oh, here it is. The sales price per unit. And the second variable is the cost of the controller. The cost of the controller is the second sensitivity variable. Now that's where you're going to have to put on your thinking caps a little bit. The selling price is easy. The selling price for the average base case scenario is $9,200 a unit. There it is. There's your variable. But the cost of controller is made up of 2 costs. If you look at Exhibit 2, one is the price of the controller, and the other is the warranty on the controller. So you're going to have to combine those 2 as a sensitivity variable for the cost of the controller. That's going to require a little bit of thinking caps, a little bit of graduate study. The price of the controller, which for the CTX13 is $1,280, and the warranty cost, which you have to calculate at $90 a year for 5 years. For the MT78, the cost of the controller is $1,260 per unit, and the warranty is $100 per unit per year for 5 years. You have to combine those for your sensitivity variable, and your sensitivity percentages are given on page 4 in that question 6, are plus or minus 10, 20, and 30%. Plus or minus there, Mr. Hassey. There you go. There are your percentages. So 2 sensitivity variables, not 3, not 1, 2. The selling price and the cost of the controller. All right. So there we have some new variables we're putting in here today. Let me just make sure I highlight those so you got them. And there you go. All right. Now let's take a look at the warranty cost. Again, this is another thinking cap question. All right. There you're going to have to require your skills of knowing the time value of money, knowing the principle of matching in accounting, and knowing your ability to do the calculation. The warranty cost is for the MX. Again, I'm reading from page 6, the Exhibit 2, the CTX 13, which is one of the analysis you have to do. You have to do 2 analysis, those 2 different products. The CTX 13, which has a warranty cost. Let me make sure these are so you can see them. There we go. CTX has a warranty cost of $90 per year for 5 years. You have to determine the present value of those 5 years of costs, and that's your warranty cost per unit. Now, if you notice in case number 3, you didn't have to do any warranty. You had your variable costs, you had your fixed costs, and then you inflated those every year throughout the life of the project, and that was it. Well, you're going to do the same thing here because your fixed costs are given in your problem at $9.5 million. There's your fixed cost, just like in case number 3, your fixed costs are a little bit higher, $9.5 million. All right. Your variable costs in the problem your variable costs in the problem are your per unit costs given in Exhibit 1. Labor cost for no matter what scenario, it's the same, $4,250 a unit, plus the parts cost of $2,500 a unit, plus the CTX 13 cost of the controller, $1,280. Those are the per unit costs. Jeez, I'm having a tough time here. Those are the per unit variable costs of this project. Add those up, and that's your total variable cost for this project. Okay, this is for the CTX 13 unit. For the MT78 product, the variable cost is the same. Which means the $4,250 per unit labor plus the $2,500 parts per unit plus the cost of the controller for the MT78, which is $1,260 per unit. There's your variable costs for that particular analysis. Okay. Your job then is to add a second line of variable costs for the warranty. Your calculation for the warranty costs for the unit. For CTX, it's $90 a year for 5 years. Oops. Hang on, I went too far ahead. So for the warranty cost for the MT78, it's $100 per year per unit for 5 years. Now, in doing this warranty analysis, getting back to that, remember, these variable costs you're inflating at the inflation rate, which is in this case, the inflation rate, I believe, is 3%. Okay. You're inflating those every year. But the warranty cost, remember, is a 5-year cost for each unit produced. So you're going to include the inflation in your 5-year cash flow analysis of those 5 years of cost that you're going to present value. So that's why it requires a separate line on your case analysis. You would have variable costs, just like you did in case 3, but then you would have another line, variable cost per warranty. So I want to keep those separate because they're two different calculations. The inflation is included in your warranty cost per unit. That's why the warranty cost is going to be the exact same dollar amount every year, because every year, 1 through 8, you're producing a product units, and in the case of the average base case, 40,500 units, that has the same warranty cost per unit every year because you're including inflation in that calculation of the present value. So this requires a little analysis, a little thinking, and a little interpretation. And that's what I'm looking for as this case. The tax rate in this case. The tax rate, 35%, quite high. Must be in California. That's the tax rate for this case, 35%. That's the tax rate used to determine your after-tax cost of debt and also your discount rate. The working capital rate. We did working capital in case number 3. You should know how to do that. The working capital is given as 10% of sales. With that, you now have the analysis and the pieces of the puzzle to complete the analysis. You do exhibits, you have tabs in your file just like this. This is why you need to be organized and plan all this out. And that's why it takes a while to put all this together. But once you complete the base analysis, you can just copy that and use it as analysis of the other things you need to do. You have that base case all set up. You can use that and just adapt it to the other product, MT78. So you're going to be doing 2 analyses, one for each controller, CTX13 and MT78, and then that'll feed off into scenarios and sensitivity analysis. But these are the key checklist items to begin to put those spreadsheets together. I'm going to post this back to the case assessment case file folder so you can see this as part of this analysis in today's video. We'll also be reviewing this again next Saturday in our review session. And finally, for our ending of our weekend video for today, here's your case number 3 solution, which is in your case number 3 file folder. This can be your template for the electrics case. You just have to add one more column for year 8. You have to add one more line for warranty cost. You have to calculate the depreciation. There's no salvage value. Everything else, follow the variables in the case and compute the weighted average cost of capital correctly as given the information in Exhibit 4, and you're there. So you can use case 3 as your template because it'll make things a lot easier for you as you go through. All right, everybody, that's our weekend review. Take a look at your case number 3 work. I have sent back your file folders. If something is highlighted in blue, it means there was an error. Please note that error, see what you did wrong. You can go to the solution as we just did here and see what you did. And then you can set this up for the electrics case going forward this week. And we'll review this again next Saturday in our review session. Look for case number 4 to be posted this evening, Sunday, and then my lecture video tomorrow to review case number 4 and our topic for week 7. Thanks, everybody. Have a great week. We'll talk to you next time.